Good day, fellow investors. As car stocks have been crashing lately, especially European ones, there are a few comments asking, Sven, aren't these at P ratios below 5 now value investments? If we take a look at Stellantis, dividend yield 11%, P ratio 3.15, that's crazy cheap, and that must be a value investment, no? Similarly, Volkswagen 3.14 P ratio, Mercedes-Benz, again, down but not that much compared to others. BMW P ratio below 5, dividend yield of 7.8%. And let's now dig into the companies, what's going on, see what are the guidances for the future, and estimate whether now at this multi-year or 52-week close, whether that is a buy or not. So I've check the last presentation from Stellantis. They are upping the range on electric vehicles, introducing new launches, the Grande Panda electric vehicle, and they expect to get a good capital return on those investments. However, reality is a little bit different. Here you have their reflection on transitory dynamics, as they say. But the key here, whatever they tell you, is industrial free cash flow near zero. So suddenly, after a few good years, sales are a little bit down, a little bit higher investments, higher inflation prices, and there you go. From great return to shareholders, 7-8 billion per year, we are now at zero. And that is also explaining the stock price movement, because the P ratio now is based on the last 12 months, but the stock price is based on the next 12 months, and next 12 months, all else equal, will be zero. That explains the stock price crash. Now, if we look deeper, of course, all these car companies have their own issues. North America is always an issue for Stellantis, a little bit lower here, but they are also investing, and they want to be in a position to support the new product wave, and that's something that you will see also through the other presentations. So new product wave, which means more supply, but when you invest, and you have to invest over years to create that supply, you never know what will the demand be, and therefore this increases the risk of your business. For now, they say it is a challenging it is. We don't know whether it is transition or not. We have not seen a recession. If we see a real deep recession in Europe, this will definitely not be transitory. Nobody can predict that, and nobody can know it. Revenues are down 14%. They hope to turn the free cash flows as positives by cost reductions, that there will be no strikes ever again, and then also on the other headwinds to try to work on those. However, you never know, and if the profits go to zero, then also it's hard to value something, therefore the stock follows. Volkswagen, similarly, if we look at Automotive, net cash flows for the first half of this year, negative, or let's say like Stellantis at zero. Everything is down, clean net cash flow, heavily down. They have spent a lot of their liquidity as they are still investing. Again, all the companies investing in positioning themselves to be market leaders, but into an uncertain market. Mercedes also down, EBIT down, free cash flow down 52%, will likely follow the path of others, and that's why all these companies usually move in tandem. Sometimes some are better, some are a little bit less, but still, this is perhaps even very, very important. The electric vehicle trend has turned. It was growth, 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 and now we are seeing the first downward trend, while all the companies are investing still hugely in this. And now we are down. Therefore, that is also a shift in the modeling that analysts likely do to value stock prices. Further, something that has always been working great for car companies are the financials. The EBIT there is also down, and therefore, when it comes to the financials, and that's something we'll discuss also here, then you know also that all those loans given out can also work backwards if interest rate changes. Plus, again, investments are going higher and higher, investment in property, plant, and equipment, so R&D expenditures, and as those investments grow due to inflation and costs, your margins are immediately lower. EBIT significantly below, free cash flow significantly below, but again, we will be able to cater to different customers' needs well into the 2030s, all new models, high investments, and then again, like Stellantis, a product offensive from 2025 onwards that they hope will lead to profits, but that is again a risk that we don't know how it will look like. Just a quick touch on Tesla. Automotive revenues are there also down, so this boom of electric vehicles has returned, but Tesla always knows what to tell shareholders: autonomy, AI, new generation vehicle platform. If they again lead on that, it will be great for Tesla shareholders. But I want to show you something here that affects all companies. If we look at the free cash flow, Tesla's free cash flow over the last few years, 5 billion 2021, 9 billion 2022, 4 billion 2023, will likely be 2 billion for 2024, and if my math is not wrong, I am at 20 billion total. Okay, free cash flow 20 billion total. I go back to the 2019 earnings report and I look at free cash flow. So we have 2017 minus 3.5, some negative in 2018, then turning slightly positive. But let's say that Tesla spent 10 billion over time to get out this 20 billion. So net earnings are around 10 billion. Nothing wrong with that, great business, but now those cash flows are already finishing, so now they need a new wave, a new generation that will require again investments, and that also shows you the competitiveness in the industry and how you always need to be a step ahead of others. Of course, big investments, but they are always doing that. And then I thought the best buy here is Tesla, but now I see that I am a few months, 5-6 months late to play on the AI jump that Tesla is enjoying. However, something that I want to share for European automotive companies is, first, we have to imagine a recession. When a recession comes, half of this parking where they sell cars gets empty. Secondly, all positive cash flows that were good in the last few years now are zero, turn into negative and destroy all the positives that we have had over the last few years. Plus, something very important that few remember is that European car manufacturers are mostly alive just because of European Bank and European Union incentives. Let me show you. This is the bonds overview from Mercedes. They have been issuing and issuing and issuing, investing and whatever. Look at the coupons. Here you have the maturity, and here you have the coupons. 137, 15, 21, 1, 15, 135, 2. So 1 point something to borrow money. All these things will be needed to be refinanced at much higher rates likely, especially if the profits aren't there. Then people say, okay, this is a little bit risky, or the euro loses its value. Look at this bond. We have here 1 billion euros. The coupon is 0.375, 2019-2026. This is free money from the European Central Bank when they bought these treasuries. So the only solution here is for the European Central Bank to print more, but they are not the Fed, and we'll see how these things, this is the biggest risk here, how these things evolve over time. I'm looking at the balance sheet there, short-term financing 41 billion, long-term financing 70 billion euros, and that is much more than the equity there. So to conclude here, automotive stocks are risky on their debt, on the riskiness that we don't know whether the demand for the huge investments they are doing now will be there. We don't know that, nobody knows. We can't predict the future, so that even more increases the risk of owning them, and as there are zero cash flows, the dividends will be cut, things will look much uglier, P ratios will be or negative or go to 50, 100, and then that explains the stock price crashing. But yes, if there is 6 months to 2 years of revival, Stellantis can double, and then you can call me stupid again. That can happen easily, but when it comes to value investing, despite the P ratio is just 3, it's hard to take this as a value investment because the risk is not justified. If there is a recession and these stocks bottom, then there are other things that even in a recession are profitable, can survive a recession without being saved by the government, like some car companies have been 2009. So those are the risks a value investor does not take. Therefore, you have never seen Buffett invest in car companies, even when those were doing great. And therefore, it is too much risk, and when these things will be cheap, there will be others much better from a risk and reward perspective. You can make 2 times, 5 times your money, but that is mostly gambling. Thanks for watching, and I'll see you in the next video.